Imagine lending money to a friend, but instead of your friend, it's the United States government. You give them money and they promise to pay you back with interest. That's exactly what a United States Treasury security is. It's a loan you make to the United States. Investing in the United States by purchasing U.S. Treasury securities is considered to be one of the safest financial investments an investor can make. This is because the U.S. is regarded as an economically and politically stable country with a great history of always repaying its debt. The U.S. Treasury uses the proceeds from these securities to fund essential government programs, build infrastructure, and to even finance the United States military. Wherever tax revenues fall short, funds from the sale of U.S. securities help bridge the gap, allowing the U.S. government an opportunity to continue funding essential investments. The U.S. Treasury offers different types of securities to meet different investor needs. There are Treasury bonds, notes, bills, and even inflation-protected securities. Each security type varies in maturity dates and interest rates. But it's still the same concept. You lend money to the United States and the United States pays you back with interest. These securities aren't just for big-time investors or Wall Street gurus. Anyone who wants to purchase these securities can buy them. United States Treasury securities are a stable and low-risk way to grow your savings. It's like parking your money in a secure vault, knowing it's earning interest while you sleep. You might be wondering, who are these lenders lining up to make all these loans to the United States government? Well, it's a diverse group. We're talking about institutional and individual investors, the Federal Reserve Bank, and even foreign national governments. Foreign countries view investing in the U.S. as a safe haven for their cash reserves. So, whenever a foreign nation wants to grow or safeguard their excess cash, they invest in countries like the United States. Further, foreign national governments invest in the U.S. because the United States of America's dollar is considered to be one of the most reliable currencies in the world. Thus, foreign governments buy U.S. Treasury bonds as a way of holding American dollars while earning interest. Among these foreign investors, China stands out as a major player. China holds a significant amount of U.S. Treasury bonds. In 2025, China held over $700 billion in United States Treasury securities, making it the second largest foreign holder after Japan. This, in essence, means China is one of the United States' largest foreign creditors. And by owning U.S. debt, China is financially supporting investments made by the U.S. Suffice it to say, the U.S. Treasury bond market is a global melting pot of investors, all looking for a safe and profitable place to park their money. Let's deep dive into China's significant holdings of U.S. Treasury bonds. Why do they invest so heavily in the United States economy? Well, it boils down to mutual benefit. Firstly, China earns a lot from the goods it exports to the U.S. To keep their export prices low, China must keep their currency relatively weak compared to the U.S. dollar. Buying U.S. Treasury bonds helps them do just that. When China sells goods to the U.S., it gets paid in U.S. dollars. If China were to convert all the U.S. dollars it receives from exports to their currency, the demand for the yuan would go up. And when the demand for something goes up, its value rises. So instead of converting all the U.S. dollars China receives from exports to the yuan, China uses a big chunk of those dollars to invest in the U.S. by buying United States Treasury bonds. Doing this ensures that the yuan stays weaker compared to the dollar. And a weaker yuan makes Chinese goods cheaper for U.S. businesses, which keeps Chinese exports strong and the Chinese economy growing. But it's not just China benefiting from this partnership. The U.S. also gains from China's investment. China's constant demand for U.S. Treasury bonds allows the United States government to borrow money at lower interest rates. When China buys bonds from the United States Treasury, it increases the demand for those bonds. A higher demand for U.S. bonds means the U.S. doesn't have to offer high interest rates to attract buyers because lots of investors, like China, already want to buy. The interest rate of a U.S. bond is like the price tag the U.S. pays for borrowing money. When the demand for U.S. bonds is high, the price the U.S. is willing to pay to borrow money goes down because there are so many investors that want to invest in the U.S. So the more China buys, the lower the interest rates can be, making it cheaper for the United States government to borrow. This means more money for infrastructure, social programs, and everything else the government needs to function. However, this arrangement isn't without its critics. Some say that this arrangement gives China too much leverage over the U.S. economy. Others worry about the potential consequences if China decided to sell off its U.S. Treasury bond holdings, a scenario that could be catastrophic for the global economy as a whole. What exactly would happen if China decided to sell its U.S. Treasury bonds? If China chose to sell its U.S. bonds all at once, it would be like the largest car manufacturer dumping a huge pile of cars onto the market all at the same time. And when the supply of a good exceeds the demand, the price will inevitably drop significantly. If China sells its U.S. bonds, the supply of U.S. bonds will increase. And if the supply of bonds increases, interest rates will rise. Higher interest rates attract buyers. Therefore, whenever there's an excess supply of U.S. Treasury bonds, the U.S. will try to attract buyers by increasing the rate of return, which is the interest rate. So what's the impact of all this? Again, for the U.S. government, this means it would have to pay higher interest to borrow money, which could make it more expensive to fund things like schools, roads, and military spending. For regular people, higher interest rates could also make things like mortgages, car loan payments, and credit card rates significantly increase. And this is because the United States Treasury interest rates set the tone for all kinds of borrowing. But what's even more concerning than rising interest rates is how China selling off its U.S. Treasury bonds could actually hurt the value of the U.S. dollar. If China sold a huge amount of its U.S. bonds, they would get paid for those bonds in U.S. dollars. And if China were to convert those dollars to their currency, the yuan, the market would suddenly be hit with a massive amount of U.S. dollars, which would cause the value of the dollar to significantly fall. Whenever a massive amount of any currency suddenly hits the market, the value of that currency will fall. And unfortunately, a weaker U.S. dollar means it would cost American businesses and consumers more to buy Chinese goods, which would ultimately reduce the United States' demand for Chinese imports. If this were to happen, Chinese businesses and jobs could be negatively impacted, especially because the United States is currently one of China's largest consumers. This means both the U.S. and China would feel the consequences of such a drastic move. Your money matters. Why understanding Treasury bonds is crucial. So, why should you, the average person, care about Treasury bonds? Well, let's make this crystal clear. Treasury bonds aren't abstract lines on a financial spreadsheet. They are the lifeblood of our shared global economy. Understanding how U.S. Treasury bonds work, who buys them, and the risks involved is key to making sense of our globally interconnected economy. When you hear about economic policies on tariffs or trade wars, think about how those policies might impact the U.S. Treasury bond market, especially if you're dealing with a country that is a significant holder of U.S. bonds. When you read about market fluctuations or global economic forecasts, remember the role these bonds play in shaping the financial landscape. U.S. Treasury bonds might seem like a complex financial instrument, but their impact is felt in our everyday lives. They influence interest rates on loans, the value of the U.S. dollar, and ultimately, the health of the global economy. By understanding how they work, we can all become more informed citizens, smarter investors, and active participants in the global marketplace.